Hey Wizard, so in this video we're going to answer the question based on value investing, are stocks cheap right now? Because obviously here looking at the S&P 500, we've seen a huge steep decline there in the value of the index. Is now a good time to start averaging in? Now the way you value stocks can vary depending on whether you're looking at something like a tech stock like Tesla or something like Caterpillar. And actually, I'm going to value Apple and Caterpillar here in this video. I'm going to show you how I value them, very quick, very dirty, very high level, and why I'm not actually averaging into stocks, or why I'm not considering averaging into stocks right now. However, I am strongly looking at averaging into crypto a lot more. So looking at the crypto market cap, I actually think now could be a really good time, and for obvious reasons, to start buying in. Could crypto drop a lot more? Yes, it could, but I'll cover that in a separate video. In this video, I'm going to focus on stocks. Now, I know it's been a while since I've been posted. I just got married. I've just been on honeymoon and it was absolutely fantastic. And now I'm back trying to get the new site for Crypto Wizards up and ready. If you want to get a sneak preview of how that's looking, just let me know in the comments. And if I see people want that, I'll do a video on that too. Right, so this method that I'm going to use here has been inspired by this book that my granddad gave me many years ago called Rule Number One. And it's got a very, very simple method in it. And I really actually like the method for very high level figuring out, is this stock really cheap right now? Should I look at buying it? Is it on a discount? Or no, it's not. I'm not a seasoned investor. I don't make a living investing, and I have no right to advise people on how to invest. But what I would say is, if I'm going to put my money into something, I damn well want to know it's a no-brainer and that it's cheap. And that's what I'm going to show you here. So there's a Google Sheets document I've put together for you. I will link this below the video so that you can go and play with this and steal it and use it yourself. So my background is that of a financial controller. At one point I worked as a finance director. So understanding financials is something I'm very familiar with. But a lot of this can be daunting for people, even for traders who don't understand the financials of companies, etc., or haven't had to care. And I thought it might be interesting to talk more about what are these things that I'm measuring here and why do I hold them as important. And a lot of this you will find in this book, by the way. I don't recommend you buy this book. I'm not saying you should go and buy it and read it. A lot of the principles from it I'm stealing in this strategy that I'm using over here. So this can be fully automated, which I haven't done yet, but it's something I am considering doing. I just don't think the market's at a point where things are cheap enough yet for me as a retail investor to go and take that kind of risk. But the technique is extraordinarily useful, at least I believe it is. And it's kind of a surefire way to make sure that even if you are buying something and you get it wrong, you really are limiting your downside as well. So the first metric here we're going to look at is free cash flow. And in fact, we're going to look at free cash flow per share. So let's go over to this website here, Macro Trends. I found this to be really useful for finding historical financial information about stocks. But here I've punched in Apple and I've got the financials down here for Apple. I can get their income statement, their balance sheet, their cash flow statement. If you'd like videos walking you through these statements and how to read them and interpret them, I'm more than happy to do that for you. However, what I'm interested in right now actually are the key financial ratios. So down here, I've got this free cash flow per share. If you can't find free cash flow per share, you could easily just use free cash flow. It's absolutely fine. Now, what is free cash flow? So free cash flow you can think of is the amount of cash that business has freely available to itself to go and invest or reinvest into itself. So it's kind of a useful measure to see how valuable that business is. You can think of it like analyzing earnings in a sense, but it basically looks at the amount of money coming in or out in terms of the operations of the business and also any capital expenditure. Capital expenditure means basically buying equipment that the business can use to make money. So it ignores long-term debt and things like that. So it's a pretty useful measure. And what I'm going to do over here is I'm just going to do this for the year 2022 and 2018 to get an idea of what that was. And then what I'm going to do is look into the future and do a future year for this as well. You'll see what I mean in a second. So the first thing I want to do is look down here and see that, okay, free cash flow per share was 1.31. So in here, I'm going to put 1.31, and this is for Apple. And going back to 2018, it was 0.74. So here I'm going to punch in 0.74. Now this was over a period of 4 years. So if I take 2022 minus 2018, that's basically a 4-year period. So you take 2018, 2019, 2020, 2021, 2022, that's 5, minus 1, that's 4. And what we want to calculate here is the year-on-year growth rate. This is also known as the cumulative average growth rate, or also known as CAGR. So to calculate that, all you do is you put in equals rate. And by the way, this will all be pre-calculated for you on the version of this that you get. So don't worry if you don't want to calculate this, but I'm explaining the calculations to you. To get the rate, you have the number of periods here, which is 4 years. And you don't need the payment per period, but what you do need is the present value and the future value. So I'm going to hit comma again to get to present value. The present value we use is 0.74, which is this 2018 number. And then the future value here is going to be, you put in a minus, and this is what often trips people up. You need to put in a minus for this number that you're about to use. Just hit there 2022. Now I'm going to fix the columns because I'm going to drag this formula down and close the parentheses there. And this is a year-on-year growth rate of 15.35%. So it works it out nicely for you. And so all I'm going to do now is copy that, and then I'm going to paste the formulas here. So I'm going to paste special formulas only, and that formula should be in there. Paste special, sorry, not format only, formula only. And here as well, I need to do that. Formula only. So these are showing errors because we haven't got any numbers in here, but that's okay. This 4 years as well, we can fix that so that we can drag that down and copy and paste special formulas as well, formulas only. Right, so let's now talk about the book value per share. Well, if free cash flow is looking at cash, what about the actual value of the business? So one of the ways you can value a business is by looking at its balance sheet. And a balance sheet has something called shareholder equity. So this is basically a way of looking at how much value is there for shareholders in the business. Book value per share is basically kind of looking at that and saying, okay, well, what is the net value available to shareholders per a share? And that's all book value per share is. So if I go back here to key financial ratios, here's book value per share. And the latest here for 2022, Apple's financial year ends in September. So for a lot of stocks, you'll see you only have 2021 information. We'll see that in the next example. But book value per share here is 3.12. So I'm going to put that in there, 3.12. And 2018, if I look at that, that was 5.63. So it's actually dropped 5.63. And that means we've had a negative growth rate. So we've had a shrink rate, a cumulative average shrink rate of 13.7%. Now, earnings per share, a lot of you already know what that is. If we look at the income statement, also known as the profit and loss, your earnings are basically it's like your net profit, right? And your earnings per share is basically how much of those earnings did you have per share. Again, so EPS. So here's earnings per share. You can see that on the income statement. Here we had 6.11, and in 2018, we had 2.98, so 2.98. And so that's a cumulative average growth rate of nearly 20%. So that's fantastic. Now what we need to do is also punch in some numbers for the PE ratio. So where can we get that? Well, we can go to price ratios, and if I scroll down, you can see PE ratio here. So that year ending 2022 September was 22.62. And right now you're seeing me just putting in hard numbers. You can also use a bit of poetic license, and I'll talk more about that in a minute. And down here, if I look at 2018, it was 18.32, right? So the PE ratio is a very important one. And one of the things that you'll see is very common here is you want to always be conservative, meaning you always want to try and make the result as difficult as possible for you to achieve the outcome. In other words, you want to try and dampen the excitement in the numbers, because if it still beats that, then that's working in your favor even more, if that makes sense. It's like known as a prudency principle. So what is the average growth rate? Well, what I'm going to do here is just put in average, and that's going to give me these average growth rates here. So my average is about 7.1%. And the idea here is to say, okay, over the last 4 or 5 years, we've been averagely growing the value to shareholders in our business of about 7%. You might want to look at this and there might be one big anomaly in there and you go, well, actually, I think 10% is a more reasonable number, or I think 1%, or actually think it should be negative. You might decide to put your own spin on it. But what I would always say is try and push the number down rather than up. Right, so now what we want to do is project into the future. So we're actually going to project now into the future to figure out what do we think the future earnings per share are. So here if I put equals FV for future value, open bracket, my rate I've calculated, which is 7.1%, I'm going to fix that. The number of periods is going to be 4 years into the future. So I'm just going to put this number 4 here for now, that's fine. And the payment amount I don't need, so I'm going to put another comma. The present value I need to put minus, so it's that same thing that usually trips people up, minus. And the present value today is 6.11. So I'm going to hit 6.11 and fix that over here. So my future EPS is actually 8.04. If we continue growing our earnings, growing our BVPS, etc., I'm just taking an average here. You could decide just to take this 20%, or maybe half it for prudency, whatever. I'm going to take the 7%. That's what my future earnings per share would be at this current trajectory with Apple. So my future PE ratio is going to be this. It's simply going to be, now here I've got my PE ratio here. This year is 22.62. In 2018, it was 18.32. I'm just going to take an average of those two numbers. Now, be very careful with this, right? Because we know stocks have been inflated, like PE ratios are astronomical. You can look at the PE ratio and just look at this trend down this column here, right? And just take an average or take a lower number of what you want the PE ratio to kind of, be at in the future. But I'm just going to take the average of these two for now to keep it mathematical and fairly simple. And also, they didn't vary wildly. Other than some years that were as low as 15. So if I really wanted to, I could say, right, let's take 17 or whatever. Now here's the fun part. We can actually take our future earnings per share and multiply it here by the future PE ratio. And we get a future stock price of $164. Now, what I'm actually going to do now is actually go and look at Apple's price today, right? So let's just go into Google and say Apple stock price. So Apple's price today is 145.03. So let's go down here, 145.03. So this is saying today the price is 145.03. I reckon in 5 years time, so actually I'm gonna make this 2022 plus 4. So in the year 2026, I reckon the stock price should be at least $164, right? Now, here's the important part. You're the investor, okay? So you want to make sure that you're getting a return each year. The minimum return that I want to get if I'm investing in the stock market, because it's risky, is 15% per year. So I'm going to punch this 15% in, and I've highlighted this in blue because once you've done this once, you're probably just going to leave that percentage in as it is. But that's what I want. You might say 20, you might say 10, you might say 100 because you've been in crypto and that's the minimum you expect. But that's what you could do here. Now, what is the maximum acceptable stock price for me then? What should the stock price be today for me to be interested in this stock? Well, if I expect a minimum of 15% return per year, then I want to discount what I say the future stock price is by 15% per year. So what I'm going to do, instead of using future value, I'm going to use PV for present value. And the rate I'm going to take is 15%. I'm going to say the number of periods is going to be 4 because I'm projecting 4 years into the future, or 5. And the payment amount I'm going to ignore. I'm going to put another comma and put minus the future stock price here, right? So I'm going to take that number and I'm going to discount it year on year by 15%. So the maximum acceptable stock price for me to be interested in buying Apple today is $94. It's currently at $145. So there's no freaking way for me as a retail investor, I would go and buy Apple. And yes, Apple could 10x from the price it's at today. That is totally possible. But this is not working in my favor, right? I want this number to be lower than this number, but right now it's higher. Now, what Phil Town will do in his book over here is he then says, well, look, just assume you're an absolute moron and that this, he doesn't say that, by the way, just let's assume we're absolute morons, but let's assume that we need a margin of safety because there's so many other factors that might come into the stock, right? So let's actually take that stock price and half it. Now that is the stock price that I'm going to use as my threshold. And I'm going to say, okay, how over or undervalued is the current stock price versus that? And when I punch that in here, it's basically $98 higher as a stock price than what I would be prepared to be interested in investing in the stock. Now this is Apple, it's a tech stock, you could look at valuing it differently, but my point is I'm not going to be buying Apple. I love Apple, most of my products here are Apple, my phone is Apple, I have a Mac Mini here, my MacBook Pro, which has not been working for the last 3 weeks, is now back up here next to me recording this video. But I'm not going to buy Apple stock because this does not give me a no-brainer. You'd be stupid if you didn't buy this stock, right? So not interested. Now, let's actually go and copy all of this over here. Or in fact, I'm going to leave it. I'm going to now go to Caterpillar and do this again. But the formulas are now entered in here for you, right? It's all already calculated for you. All you need to do is enter in these yellow cells here. That's it. And here we go. So we've got Caterpillar up here. Let's go and look at, for example, our earnings per share. So 11.83. Now this is 2021. So in here, I need to change this to 2021 and I need to put this to 2017. You can go back 10 years if you want to. And in fact, that's kind of recommended. And then look 10 years into the future. I'm going back 5 just to keep it easy. But here I've got 11.83. So my earnings per share is 11.83. And 2018, 2017, so 1.26. So that's a massive jump up. That's a 75% increase. Now I can use some savvy here because this does vary quite a lot, right? So maybe there was some funny business going on here. I might decide to say, okay, actually I'm going to take an EPS of 3 for this. So here you can use poetic license. You can use a bit of savvy to say, okay, was there some weird turbulence? Like if I'm looking at United Airlines or British Airways, you know, we had COVID hit, etc. Like you might want to smooth something out to be like, okay, that's an anomaly. Let's adjust for it. But I'm just going to keep to the number that was in there. The free cash flow per share, I'm going to go back and look at, and this is why we look at different ratios here. The reason is because you can't just rely on one, right? You want to get a balanced view of the value of the business. So here, free cash flow per share, 1.83 for this, 1.83. And here in 2017, it was 1.3, rounded up 9, 1.39. Now book value per share is 30.82, and in 2017, book value per share is 23.03. Great. Now what about the PE ratio? So let's go to price ratios, and if I scroll down here, I can see a price ratio in 2021, December of 17. And I can see a price ratio. And again, PE ratios, you can be very poetic about how you want to do this. But I'm going to take here December. It was, so here's a big anomaly, right? So clearly there was an issue here with earnings or something. I don't want to take that number, right? I'm going to take, not even these ones. These were extremely high. I'm going to take this 35 number over here, right? So that's what I'm going to take. And then the average PE ratio, you know, is going to be whatever the average of these two numbers. So if I scroll up, I can see it does average probably around 15 if I'm being conservative. But that's fine. Let's leave these numbers in here for now. It's going to take 26 as its average over here. If I wanted to drop this, I could drop it down to 25. Now it's giving me an average of 21 to be conservative. But that's how I'm going to do it. Now, what is the future stock price of this? Well, it's saying, you've got growth of the business here of about 30% year on year. And a lot of that is because of this 75% number here. So what I might choose to do is just take the average of these two instead, right? These ones here. Or maybe I just say, okay, well, let's say it's 7% plus 10 to assume that there is some good value coming in the business. That's not very conservative, but let me say I just punch in here 15%, right? That's something you could do as well. But I'm going to leave it as a formula so that when you use this spreadsheet, you've actually got the formulas in here. Now, if we go here and just put instead of Apple, what is Caterpillar's price today? It is 214.54, right? So here, 214.54. Now, this is actually saying Caterpillar today is, because it's 214.54, is actually undervalued. So this you could consider investing in. But what I'm going to say over here is actually what we want to do is just drop this number over here. So this average growth rate, let's just make it 15. And that actually says it's overvalued. So the key takeaway for you here is that, or at least what I'm saying, is that it is not worth buying stocks right now. Okay, it's not worth going in and investing in the stock market to buy stocks as a retail investor, because no matter what way you kind of look at this, stocks are still pretty high. Now, what about cryptocurrency? How would we do this with crypto? Is it worth investing in crypto right now? And to me, that's actually a very different discussion. If you want me to do a video on that, which I'm planning on, again, you can put that in the comments, and I'll show you how I look at actually valuing crypto businesses from a value investment perspective. Nonetheless, I will link this spreadsheet down in the comments because no doubt it will be useful to some of you guys and gals. And again, also, if you want me to cover behind the scenes of what the new Crypto Wizards platform is looking like, because I expect to launch it in about 4 weeks, I will do a video on that showing you behind the scenes as well. Until the next one, take care and talk soon.